Welcome back, everyone. Today on the Joseph Carlson Show, we're going to be looking at two stocks in particular. They are FICO and Equifax, and why these two companies are the best ones to buy as interest rates go lower. That's right, we heard from Jerome Powell just today. He gave us a clear indication that interest rates are going down in the near future, as early as next month. And the market is reacting. Stocks are ripping, the market's going higher. But out of all the stocks that are going up, there's going to be a couple that actually benefit more than others from interest rates declining. In fact, there's going to be some that disproportionately benefit to a huge degree. And I'll be going over FICO and Equifax and why those are number one and number two. We'll be looking at the math. We'll be looking at the reasoning and charts and data behind it. So we'll be looking over the case of those two companies, why they're such strong buys, as well as Jerome Powell's remarks, and we have a lot of other news. Google stock keeps winning and winning. This time they struck a deal with Meta, which is a $10 billion cloud deal over the next 6 years. We also have Google winning while giving very awkward, ill-prepared presentations with personalities like Jimmy Fallon. Even Jimmy Fallon, trying to sell a phone that he's clearly never used, couldn't keep Google down. But there's still some risks for Google. Even though they're stacking up these wins, they're facing a couple things. One of them is the judge's ruling to sell Chrome. We'll be looking at that, as well as the judge's ruling to potentially prevent Google from being defaulted on search engines like Safari. This is a massive, massive news for Google, but if the judge rules in favor of this, it could actually end up being better for Google. Now, we also have news that Intuit just reported earnings. This is one of my larger holdings. It's down 5% after beating their earnings and giving decent guidance. So what gives? What's the problem with this earnings? We'll take a look at it. And then we also have the fail of the week, which is the Cracker Barrel rebranding. Cracker Barrel has updated their logo, reflecting modern times, taking away all uniqueness and anything interesting about the logo, and making it more simplified. And people so far are not reacting positively. We'll be taking a look at the case of the Cracker Barrel rebranding. So we have a lot to get to in this episode. Now, first of all, I'll just take a look at my portfolio. If you're looking at your portfolio today, you're noticing that it's going higher. It is almost impossible for your portfolio to be down today. Most stocks are moving up dramatically, but some more than others. When I look at mine, every category seems to be doing rather well. The only stock that's really moving down is Intuit, but that's a special unique case because they just reported earnings. So that one's a little bit of a caveat. Outside of that, all these companies are moving higher. When we look at the overall passive income portfolio, it's now at all-time highs, near $360,000 in gains, $913,000 total. And if I switch over to the story fund, we're near all-time highs as well, $389,000 total, $165,000 of that being gains. It's up around another $6,000 or $7,000 on the day. If we break this down by the companies that are moving, Netflix and Duolingo are a little flat on the day, but the other companies, Amazon, Google, Microsoft, S&P Global, they're all moving up big, lifting the overall portfolio. And this isn't just my portfolio. Like I said, the entire market is moving up today. Microsoft, Amazon, Google, Meta, even Tesla's getting in on the action. Broadcom, Uber, ServiceNow, even Salesforce is moving up a little bit. We have all the banks and financials in the green heavily across the board. Now, what's causing this dramatic shift in sentiment on the day? Well, of course, it's Jay Powell, the guy that's in control of our interest rates. Federal Reserve Chair Jerome Powell today gave a tepid indication of possible interest rate cuts ahead as he noted high levels of uncertainty that is making his job difficult for monetary policymakers. He cited sweeping changes in tax, trade, and immigration policies. The result is that, quote, the balance of risk appears to be shifting. So like always, the Fed's trying to balance their dual mandate, having low inflation and low unemployment. And they change policy to reflect whatever one is the biggest concern. And right here we can see that these concerns are shifting in one direction. With the Fed's benchmark interest rate a full percentage point below where it was when Powell delivered the keynote a year ago, and the unemployment rate still low, conditions, quote, allow us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. And that was enough. Jerome Powell has accomplished his goal of signaling to the market that he's going to be cutting rates. And the market's good at reading between the lines. They can see that when Jerome Powell is posturing, saying that we're too restrictive or opening the door to rate cuts, that means rate cuts are happening soon. Right now, the market's pricing in a 91% probability that the rate cuts happen next month in September. So they're almost certainly going to happen after these remarks. Otherwise, Jerome Powell would be very much misleading the markets, which isn't good. So we have rate cuts happening. We have the markets reacting. Stocks across the board are going up. Most of them are in the green today, but there's going to be some that benefit far more than others from the rate cuts. And that's what I want to highlight too here. The first one is one that we know really well, which is FICO. Now, this is a stock that I've kept an eye on for a long period of time. It's a Dev Kantasarya stock, his largest holding by far, and this one has been obliterated year to date in 2025. If we look at the stock price, it is down 28% this year. So it's just getting crushed. I mean, there's not a lot of stocks that are down 28%. There's usually lower quality value stocks, maybe ones going through particular trouble, or ones that have really bad narratives associated with them. For example, another company that's down around the same amount, but not even as much, is Salesforce. If we look at Salesforce, this company's doing better year to date than FICO. That just gives you an indication of how much FICO is struggling. It's doing worse than Salesforce. So what is going on with FICO, and why is this company such an interesting buy today? Well, FICO is a company that makes money one of two ways. I can highlight it here by looking at their revenue by segment. So this breaks it down into basically two different categories. The first and most profitable one by far is the scores. The FICO score. This is a very important score in your life. It allows you to get credit to buy homes. It allows you to get credit to buy cars. It allows you to get credit to install solar systems and security systems. Anytime you want a substantial loan, they're going to look at your FICO score. It is the industry standard. It is the brand name. It has massive network effects. And this portion of the revenue makes up around 50% of the overall revenue. If we look at the other 50%, it's actually a little bit less than 50%, but it's the software. FICO leverages the data they have from their scores, and they create a lot of software, a lot of subscription businesses from it, and they monetize it that way as well. But by far the more important part of this company is the scores, and that's what's caused a little bit of trouble for FICO. To basically summarize what's happened over this year, FICO raised their prices of their scores from around $1 to around $5 in just a couple of years. Now, when you have this thing, the FICO score in this case, that used to cost $1, now it costs $5, there's two basic ways of looking at this, two different viewpoints. There's the government's viewpoint that this is a massive monopolistic price increase. They increased the prices by 400% over only a couple of years. What type of company does that? What company increases prices by 400% plus over just a couple of years? That's the government's argument, that FICO's implementing these grueling, harsh price increases, doubling, tripling, quadrupling the price of their score in only a couple of years, making it so that everybody across the board is paying more money to FICO to enrich their shareholders. That's big bad FICO, and the government's trying to prevent them from doing that. But then you have FICO's perspective, where the CEO's saying it's a $4 increase, and FICO score still costs less than a cup of coffee. When someone's buying a home and they're trying to get a loan to buy a $500,000, $600,000 loan, they're not concerned of whether or not the FICO score is $4 or $1. They're not concerned about that at all. It's not even relevant. It's so insignificant. It's so de minimis that most people don't even know what they're paying for the FICO score because it doesn't even show up on the radar. In fact, what people are concerned about are the overall closing costs, paying the realtor the huge percentage of the cut of the sale, paying the mortgage brokers the huge cut, paying the origination costs and closing costs, the $6,000, $7,000 cost, FICO only makes up $4 or $5 of that. So you have these two different narratives, and they're both true at the same time. FICO has raised prices aggressively, and they still don't make up a big percentage of the overall cost at all. They're still insignificant. So there's merits to both arguments. Now, either way, whatever side you align with, this has been overall bad publicity for the FICO brand and for FICO's company. It's drawn a lot of attention to their pricing power. And that's the thing that FICO shouldn't have happen. If you're in a position where you have a lot of pricing power, where you're really a monopoly, where you really can leverage your tools and charge way more for them, you don't really want to advertise it. You kind of just want to do it slow and methodically without drawing a lot of attention to yourself. The people that don't have pricing power are the ones that try to talk like they do. In the case of FICO, this is a company that has true pricing power, and now there's being a lot of light shined on it, which is not good for their brand. So a lot of people are concerned that with the extra scrutiny on the company, with the government breathing down their neck now, focused solely on them, that it's going to limit their ability to raise prices in the future like they have in the past, because they'll be a little bit more tepid. They'll have a little bit more trepidation about doing this in the future. And so investors are pricing in this extra scrutiny, this extra brand damage, the focus on their pricing power by lowering the stock price. Now, if interest rates go down, like we're seeing right now, that doesn't matter quite as much, because there's two different ways that FICO makes money: by raising prices on their scores and having more volume of scores. If interest rates go down, FICO will inevitably have more volume of scores. More volume of scores is even preferable to price increases, because they're getting all this extra revenue without raising prices on customers. Now, if you combine that with the price increases they're expected to have next year, that combination means a lot more cash flow for this company. So if interest rates start to trend down and more people buy homes, interest rates are lower on homes or mortgage rates are lower, FICO's volume for their scores should increase, causing revenue to grow significantly and more cash to fall to the bottom line. If they continue to raise prices on top of that, which I believe they will, even in spite of the government scrutiny, I think they're going to make a lot more money in the future. And that is why I highlight FICO as the number one beneficiary of interest rates going lower. Now, I don't own FICO, but I own number two, the company that I think will be the second largest beneficiary. And in my opinion, I actually believe that this company is better adjusted in terms of risk and reward than FICO. I like this bet more, and that is Equifax. This is a large holding in my portfolio. Equifax is a $54,000 position, currently only $3,700 in the green. But this is a new position, so it hasn't had too much time to compound. When we look at Equifax, there's a couple reasons why I actually prefer this one over FICO. And like I said, one of them is that FICO is under a lot of scrutiny. There's a lot of bad publicity. There's a government really focusing on this company. And Equifax doesn't have quite the focus. In fact, they've been a lot more friendly to the government. I don't think they're looking at them with quite as disdain as they are FICO currently. But that's not the biggest point. The reason that I like Equifax is because of two different reasons. For example, when we look at the free cash flow of this company, it's all over the place. Let's go ahead and take a look at time periods. We can zoom in to the past 10 years of when the free cash flow was most recently at the all-time high, before today. We have it back in 2021. Free cash flow was $865 million in 2021 over the trailing 12 months. So all-time high free cash flow. This was the huge amount that they were generating. And what was going on in 2021? What was the buildup? What was causing so much cash flow to flow into this company? Well, we can see that visualized right here. On this chart, there's a lot going on, so I'll try to break it down. These blue bars are the number of inquiries to buy a house. Basically, the number of hard pulls. So whenever you buy a house, you have to get your credit pulled so they can lend you the money. They want to know your credit history. There's 3 credit bureaus, and Equifax is one of them. Well, during the time period where there is the most credit inquiries, people refinancing their homes, they're doing all sorts of new business with mortgages, that was in 2020 and 2021. And there you have this chart aligning, right? Back in that time period, the free cash flow is going to record highs because the inquiries were at record highs. So this company directly benefits from a massive increase in credit inquiries. Now, you may look at this chart and wonder, why were there so many hard inquiries, so many mortgage inquiries and credit inquiries in 2020 and 2021? Well, if we map this out with the federal funds rate, it spells it out for you. In 2020 and 2021, the federal funds rate went to essentially zero. Therefore, the interest rate on mortgages went down, and people wanted to refinance their loans. There is a huge increase in mortgage activity as interest rates went down. But as interest rates started to go back up, in fact, they went up dramatically, mortgage lenders priced that in very quickly. What happened to the amount of hard inquiries? They went down and down and down, more and more and more, until they are where they are now. Where they are now is around half of their normalized volume. So right now, there's around half the amount of people getting hard pulls on their credit, buying homes, and that type of activity than there has been since 2015, since the past decade. And if we compare where we are currently right now, as of the past couple of quarters, to where we were back in 2020 at the peak in mortgage hard inquiries, we are like a third or a fourth of where we were. We're not even close. So around a third or fourth where we were in 2020, and we're around half of where we were over the past 5-year average. Either way you look at this chart and you see that we are way below our historical norms. This is not a normal environment to be in. We are operating right now as a country doing far less home buying and selling because we're in a more restrictive monetary policy than we've previously been in. Interest rates are just more restrictive. People aren't able to afford homes, so they're not doing as many hard inquiries. Now, even as we're in that environment, what's going on with Equifax? The free cash flow has reached all-time highs, surpassing even the peak in 2021. That's right, we've never been in a time history in Equifax's history where they've earned more free cash flow. In fact, you can zoom out to their total history. So how have they accomplished this? Well, even with volume going down and the amount of hard inquiries going down, Equifax has offered new products. They developed new ways. They have combinations of things like the twin number, where they combine their workforce solutions number, work history verification, with their credit reporting. For example, if you look at the workforce solution number, this product is growing like crazy. Look at the growth of it over the past 5 years. And this is because they're developing more and more data. They're layering products together, combining data together. For example, if someone wants to give someone a loan for a home for hundreds of thousands of dollars, not only do they want their credit history, but they want to verify that they have a job and they have stable employment. That's where Workforce Solutions comes in. And Equifax is unique in the credit bureaus to provide this additional solution. So while a lot of companies have been struggling due to this decrease in hard inquiries, Equifax has been fine, and they've been growing even through this decrease in volume. Now, what could happen in the future? Well, of course, if interest rates start to go down meaningfully, meaning they drop 0.25%, 0.5%, a full percent, it should in turn over time lower the interest rate required to get a mortgage, which should increase the amount of mortgages people want to get, the amount of refinancing that's done, the amount of new home buying, new home selling, and of course it should also be stimulatory to the job market, making it so that more people find jobs and are hired for jobs, which both benefit Equifax. With the job portion, it's with Workforce Solutions. And with the increased mortgage volume, it should benefit their credit rating business. And that money should fall to the bottom line of the company. As they say in this presentation, there is big upside with the mortgage recovery. So if mortgage rates just go back to normal historical terms, free cash flow for this company should grow substantially. And with that growth, it is near all profit. It should basically be able to drop to the bottom line, being dispersed as dividends and buybacks. This is a company that should do really well if mortgage volume starts to pick back up. It should be one of the most direct beneficiaries, as well as if there's more hiring of people, which happens in lower interest rate environments. So I'm very excited about both Equifax, and I think FICO is a great pick as well. My personal preference, again, is Equifax. That's the one that I choose to own. But these are two companies that both will be big beneficiaries if interest rates continue lower. Now let's go ahead and move on to some news. Now, first up, we get to some exciting news. If you're a Google shareholder, which I am, we have more positive developments for Google, which seem to be stacking up for the past year. Google scores 6-year Meta cloud deal worth over $10 billion. So we have Google and Meta now becoming besties. They're friends now. Meta has agreed to spend more than $10 billion on Google, their cloud services, according to two people familiar with the matter. So this was reported by the Information. And it says that Google's aiming to land big cloud contracts as it chases larger rivals, Amazon Web Services and Microsoft Azure and cloud infrastructure. Earlier this year, Google won cloud businesses from OpenAI, which had earlier been deeply dependent on Microsoft's Azure infrastructure. So if we look at Google as a whole, this company, I've been saying this for a while, that I believe even if you're a little bit nervous about search, like if that's a point of just nervousness, you don't know how it's going to pan out with ChatGPT, with Grok, with all these different competitors to the Google search engine. Well, even if that's the case, Google's a lot more than search. And one thing that I really anchor onto, it kind of calms your nerves whenever you're thinking about Google, is that this company owns YouTube. They have massive subscription business with YouTube, over 100 million subscribers. So YouTube is both kind of an advertising business plus subscription business. And then they have Google Cloud and they have Waymo. Waymo is a little bit more of a far long shot bet. But even if we just focus on two of these, YouTube and Google Cloud, I believe both those segments of the company, each in and of themselves, will be worth $1 trillion in around 5 years. When you put $2 trillion, one from cloud, one from YouTube, You have $2 trillion, which the entire company today is worth 2.4. So basically, you have a lot of downside protection. And I'm not under the belief that all the other businesses that Google owns are going to zero. I don't believe that Android and Chrome and search and all the other, outside of YouTube and cloud things are going to zero. Those are going to be substantially huge businesses in the future. Now, we have this news here, and this is great for Google. It just shows that this company is attracting the best companies to do business with them. The way that Microsoft is growing so quickly is through cloud migrations, moving people that already use their services from on-premise to the cloud. But Google's not relying on migrations. They're attracting outside businesses that aren't using Google tools. That's not the reason Meta wants to do business with them. Meta's choosing the best cloud partner for their needs, and they're choosing Google Cloud. At the same time, we have Google stacking up all of these wins, just winning left and right. We also have a couple L's. I think Google can take on an L here with their presentation. And their first mistake, even though I think he's a nice guy, I don't have too big of a problem with Jimmy Fallon. I know some people don't like him or they believe that he's a little bit insincere with his laugh. I think he's just a late night host. I think it's a bit of an antiquated form to begin with. But Jimmy Fallon seems like a nice guy, but he's not the right guy to promote the Pixel 10 Pro. And that's exactly who they chose to promote it in this live stream. Now, Google did a couple mistakes here. First of all, they did it live, and they did it with a host that clearly doesn't use Google products. Like Jimmy Fallon, I'm sure after watching some of this, that he's an iPhone user. He's just not familiar with this phone. He's holding the thing like upside down at one point. So it is comically embarrassing, so embarrassing that some parts of it are kind of fun to watch. But overall, it still got the point across. Google's making incredibly powerful AI-enabled phones with insanely powerful cameras. I can go ahead and highlight one part of it here.
It's the highest quality zoom on any smartphone, and it lets you zoom up to 100x. So this picture, it looks incredible, right?
Oh my God, yeah, that's me driving into work this morning.
It looks just like New York City.
Yeah.
Because you'll see that it might not, if you take it from where we actually took this shot from, way back there.
Whoa!
Now that's you driving in from...
That's rad.
Exactly.
We've seen these presentations before, but that is pretty impressive. Zoomed in that far, looking that good, shows how powerful this camera is on this phone. And they also showed off tons of features. I'm not going to go through all of it in this, but Google's obviously making great hardware now that I think is becoming more competitive. Now, Google's still hanging around $200 per share, and I believe that it's still going to continue to go higher because there's a couple things overhanging on the stock. The judge's ruling on this case that they've been dealing with. One of the things they've been dealing with is buying defaults, paying $26 billion to default on Safari.
Hey, Morgan. So if the DOJ gets its way, Google would be banned from paying companies like Apple and Mozilla $26 billion a year to be the default search engine. And that might act.
This number, by the way, 26 billion, was in 2021. It's probably like 30 billion, 30 plus billion dollars. That's a fortune that they're giving over to these browsers. Just a fortune in amount of money.
Apple and Mozilla $26 billion a year to be the default search engine, and that might actually be good for Alphabet. Antitrust economists, including a former FTC chair, tell me that those payments function more like innovation insurance than demand drivers. In Europe, where users pick their default, Google still holds 90% market share. And even after Microsoft spent $100 billion trying to make Bing competitive, it still wasn't a viable alternative. Apple testified to that, saying that Google simply delivered better results and monetized more effectively. And Wall Street sees upside. Slashing tens of billions in traffic acquisition costs could lift margins, and Google's already proposed a fix to that effect. Shorter contracts, multiple providers, no blanket exclusivity.
So even if the big bad judge comes in and says Google can no longer pay this enormous amount of money to be defaulted everywhere, that's money that Google doesn't have to pay anymore. And if you look at the amount, $26 billion, that's a staggering amount even for Google. The amount of free cash flow the company generated is around $70 billion. So we're moving that from $70 billion to $96 billion. I mean, that's enormous. They could potentially lose a tiny bit of market share. That's the risk there. But in Europe, where they have to pick the default, they don't just default to Google, Most people are picking Google. It's still around 90%. So even in markets where they've had to do this already, it hasn't been demand destructive. So the amount of money they actually save in paying for all these defaults could outweigh any market share loss. There's a huge potential of that happening. In any case, Google seems really well positioned right now. All we need to hear from the judge is that they're not going to force them to sell off Chrome. Now, moving on, we get to news of Intuit. This company's down around 5% on the day, and it's one of my larger positions. When we look at what's going on with Intuit, the reason the stock's trading down, well, they just reported their earnings, and we can take a look at some of the highlights here. In 2025, which is the fiscal year they just ended, they have a different fiscal year than calendar year. So they just ended their fiscal year with 16% growth. But this last quarter was 20% growth. That's fast growth. They're growing 20%. That wasn't the issue. That's not the reason that they're going down today. It's because of guidance, but overall, this past year looked fantastic. We also have here their guidance, and this is the reason that the stock is a little weak today. The full year guidance for fiscal year 2026 projects revenue growth of 12 to 13%. 12 to 13% is slower than 15 to 16% they've been growing. That's the reason investors are exiting the stock. That's the reason we have a little bit of a mild sell-off today, is because growth is going down slightly from 16% to 12 or 13%. Now, they also estimate EPS growth of 13 to 15%. That's GAAP, and non-GAAP of 14 to 15%. So overall, we see a slight slowdown in revenue growth, but around the same amount of earnings per share growth. It doesn't look so bad, and that's the reason why the stock isn't down 10% or 20%. It's only down 5%. And this is a company that's performed really well over the past year. So when we look at Intuit, it's still in the green by 6% year to date, but investors are taking out a little bit of gains. And in my opinion, this is reasonable. It's not such an unreasonable thing. Intuit trades at a higher PE ratio. It's a company that investors have done really well in. And if you're getting signal that they're going to be growing a little bit slower, you could trim your position in this one and put it into other companies you think are at a little bit better of a valuation or are growing a little bit faster. That's not what I'm doing in this case. I'm going to hang on to my Intuit shares because I don't see anything really wrong with this report. I don't see anything wrong with the guidance, but I understand why some investors are taking gains here and realigning their portfolios a little. Now, finally, we get to the fail of the week, which it's been a while since we've done one of these, but this story fits really well. We have Cracker Barrel and their rebranding fallout. Now, you've probably seen this by now. This has been hyper viral if you've been on Twitter or really online anywhere, that Cracker Barrel is changing their logo. They're changing it from a logo that is interesting, old-timely, it kind of themes the restaurant. You have the guy there leaning against a barrel. You have Cracker Barrel right there next to it. It brings a lot of kind of feelings and memories when you see that. You notice Cracker Barrel. You have the logo there. It's interesting and dynamic and unique. There's no logo like it, and they rebranded it to this. That's the new logo. It's a background that's completely plain. There's no depth at all, and there's two colors: the dark gray Cracker Barrel text and plain flat text, and then the yellow background. And that's it. They went from this, a little bit interesting. It's not super crazy, but just a more interesting dynamic logo to a completely soulless, plain logo that fits very well with the modern, simplistic, minimal vibe that you see every company doing nowadays. Now, even Cracker Barrel is seemingly susceptible to the modern times. When we look at what's going on, this also unleashed a lot of fallout. For example, a lot of people are very upset about this. Cracker Barrel shed almost $100 million in market cap value after the stock plunged Thursday following the release of a new logo. To some people that are reading this that are not in the stock market, this might seem like a big decline. Oh no, it shed 7% at $94 million in market cap value. If you've actually looked at what's going on with Cracker Barrel, you'll realize that that's not a big deal. And this is where I want to defend the CEO a little bit here. I won't defend her the entire time, but I just want to defend her on a couple points. The CEO comes into this company called Cracker Barrel, and she has had success from Taco Bell. Taco Bell's doing great, right? She was the president of Taco Bell. She comes into Cracker Barrel, and she's looking at the mess she has to deal with. And this company is a mess. If we look at what's happened, the stock fell 7% after her rebranding efforts. Let's take a look at the stock over the past 5 years. It is down 54%. It was as high back in 2021 as $175. Now we look at the price and it's down to $55. Cracker Barrel stock has been crushed, obliterated before this rebranding effort, before this CEO had anything to do with it. So she's coming into a company that's in distress, and it's not just in the stock price. Even though the revenue's growing, which may kind of shield you, or at least it kind of diverts your attention away from the underlying fundamentals, the revenue's only growing 2%, 2 to 3%, which is slower than inflation. So we have inflation adjusted, no revenue growth. We have a company that the net income, which is a more important metric for restaurants, has plummeted, going from around $200 million, being a profitable enterprise, down to now $35 million, $70 million, $57 million over the trailing 12 months. That's not a lot of net income. For a company this big to be generating $60 million is nothing. They're on track to be going bankrupt, to be taking out debt. I mean, this company is in real trouble. Real trouble. This is not something where they're a company that's just kind of floating along, doing well, and they don't need to make any changes. She sees that this company's in dire attention of a change. It needs something to happen. And she's probably just looking at it thinking, we need to update. We need to do what these other restaurants are doing and update our menu, update our brand, giving it a new fresh feel, doing all these changes that might breathe new life into it. Because look what's happening with all these other restaurants, right? Chili's has done this. We have Olive Garden. Texas Roadhouse is crushing it. So of course she's implemented a team to go through and refresh the brand and update the restaurant to try to turn this Titanic ship around before it hits the iceberg of going net income negative. Once that happens, it's incredibly difficult to turn things around. Once you start taking on high interest debt, your expenses stack up, it becomes even more complicated. So she's trying to get ahead of that, but this is where I can't defend her. I would understand if she just decided to update the restaurants, make the service better, refine the menus, make the offerings a little bit more attractive, and come out with a marketing campaign. I would even understand if she did some branding updates to the menu to simplify it while keeping the overall theme of it. But what she did was entirely erase the theme. Change it so much as it's not even recognizable. Like if I was just driving across the road and saw this on a billboard, I wouldn't even recognize it. It looks entirely different than the logo before. This is a dramatic, huge change. So this was, I think, an over-tuning. This is too big of a change. She went too far with the simplification. This logo went from fun-loving and recognizable to completely soulless. And it's also not something that matches restaurants that are also doing really well right now. I don't know of any name brand sit-down restaurant that has as boring of a logo as Cracker Barrel, with no visual elements whatsoever. Why did she have to pick on the logo so much? Look at Texas Roadhouse's logo. It's fun, it's bright, it's exciting, it's intricate. There's different colors, there's visuals. It has a Texas with a cowboy hat. Like, it looks interesting. When Chili's updated their logo, although they changed it, they actually made it more colorful, more interesting. Here's what the logo looks like now compared to its historical logos. It actually has more color and vibrance in it, and this company's actually doing really well right now. And I could show you many more examples of companies that are sit-down restaurants doing great with more complex, interesting logos. So there was no need to make this logo soulless and lifeless. And there's a lot of other ways to turn around restaurants. In fact, one example that I'd highlight of a CEO that's coming into a declining brand, one that was close to filing bankruptcy and is successfully turning it around, is the CEO of Red Lobster. Let's go ahead and take a look at the efforts he's making. When I look at what he's doing, he is turning around this brand by making it relevant, making it feel young, and an advertising and social media blitz. What he's doing is he's visiting everyone every way possible and talking about how good they're going to be treated and how much better the value is at Red Lobster. Here's one of the new advertisements that I see running all the time.
Hi, I'm Damola, CEO of Red Lobster. It's a new day, and we're making changes we think you'll be happy with. For starters, we're bringing back some fan favorites.
Hush puppies.
Yep, they're back. And there's plenty under 20 on the menu. Plus, happy hour $5 drinks and appetizer deals. One thing that won't be changing, these Cheddar Bay biscuits. We got that right the first time. Welcome back.
He knows what to change and he knows what not to change. He has been everywhere on all different shows talking about how they are making substantial changes to Red Lobster. They're making this a top-tier experience restaurant.
So, how does this new CEO plan to save Red Lobster?
We'll get the ultimate feast.
We sat down for a chat over some, well, lobster.
He's going on to CNN, doing full interviews with the menu, arranging for this type of media publicity. He's going on to ABC morning shows, talking about how now they have red carpet service. They're going to treat you right when you come in. Things are going to be priced with great value. He's even appearing on full hour-long podcasts like The Breakfast Club, just shooting the breeze, talking about all the different things they're implementing with the restaurant, how they're implementing best practices across the board, the red carpet service again, how they're changing the menu to make it far more attractive and affordable, all these different things with their wait staff, their organizational structure, and they're doing the right moves. This is being really well received. You can see it in the comments. Many people are saying, I'm going to go to Red Lobster and try it out. Seems like they're doing a lot of good things and they're going to try to make a lot of changes. What are the results of all these appearances, the effort from the CEO, conducting this social media blitz, getting out in front of people saying, we're going to do this right? Well, the reviews are coming in. They're flooding in. The chain monitors online reviews that gauge how happy diners are. Positive comments now far outweigh negative ones, and the overall ratings are trending well above the industry average. This is the way that you turn around a failing restaurant chain. The way that you don't turn it around is by making it feel lifeless and corporate, taking away all charm that it previously had. And that is why the Cracker Barrel rebrand is the fail of the week. Now that's going to be it for this episode. Hope you enjoyed. See you in the next one.